Hi there, and welcome to Chapter 1, Introduction to Financial Statements. So, if I were to ask you what accounting is, you'd probably give all kinds of answers ranging from keeping books and records of financial transactions to income taxes. And your answers wouldn't be wrong. It's all of that and much, much more. But let me ask you this. Do you like stories? Well, most people do. And accounting's all about storytelling, just not in the literary sense that you're used to. Accounting is about telling stories about the financial performance of an organization to different readers. Now, we call those readers users, and those users read accounting stories for one primary reason: to make decisions. So we start the course and our textbook with an introduction to financial statements, which essentially are the chapters in the story of the performance of an organization. So this chapter has three primary learning objectives. The first is going to be to identify the forms of business organization and the uses of accounting information. Second, we'll explain the three principal types of business activities. And third, we'll look at the four major financial statements and talk about how they're prepared. So let's get started with talking about the different forms of business organization and the uses of accounting information. There are three major types or forms of business organization, and you've probably heard of them all. The first and most basic business organizations is sole proprietorship. These are the simplest to start and in Canada require no real formal documentation other than inclusion on your annual tax return. Now, this isn't to be confused with any business licenses that might be required by municipalities. Sole proprietorships are owner-controlled and are essentially part of the taxpayer, though business-related transactions should still be separated from personal transactions. In addition, the sole proprietorship can offer some tax advantages in Canada, such as being able to deduct business expenses to offset business-related income. Unfortunately, a sole proprietor is subject to unlimited liability. So for example, if you have a painting business and while you're painting somebody's house, you accidentally set it on fire and destroy it, and if you have no or inadequate business insurance, you're personally liable for any damages to your customer. In addition, access to capital is limited to the sole proprietor's borrowing capacity. Finally, a sole proprietorship ends when the owner dies or business ceases. A partnership, however, is an extension of a sole proprietorship which includes two more individuals working together, and the largest advantage of a partnership is having others bring more skills and resources to the table. Partnerships are also simple to establish and require no formal paperwork. Control is generally shared equally by the partners. The tax advantages are similar to those of a sole proprietorship, and the partners are still subject to unlimited liability. The catch is that the liability is not necessarily shared equally. So for example, if you and your partner have that painting business and destroy a customer's home, and your partner disappears to Costa Rica, you're left holding the bag and will ultimately have all the liability for the damages. The partnership ends when one of the partners dies or the business ceases operations. Lastly, there's the mighty corporation. Now, corporations have access to a greater pool of resources by being able to issue shares to raise equity funds and are not tied to an individual. A corporation can have an unlimited life as its shares can be transferred to other owners through the buying and selling of equity shares. A corporation is also a separate legal entity and, in essence, is considered a taxpayer. In addition, the liability of an investor is limited only to the amount invested in the corporation. So for example, if I capitalize my painting business as a corporation with $100 by issuing myself 100 shares at $1 per share, my personal liability is limited to that $100. My customer who lost the house in a fire can try to sue my company for damages, but not me personally. The big companies you're most familiar with, such as Apple, Bell, Rogers, and Microsoft, are all corporations. Now there's one other form of organization that isn't formally included in this slide and you might be involved in, and that's a nonprofit organization. Nonprofits or charities are neither proprietorships, partnerships, or corporations, and individuals don't own parts of a nonprofit. However, there is considerable legal work involved in setting up a nonprofit and many rules that must be adhered to retain nonprofit or charitable status. You might be employed in or on the board of a nonprofit, and some examples you might be familiar with include World Vision or the Canadian Cancer Society, among many others. Let's now consider who reads our accounting stories. Remember earlier, we determined that users rely on accounting information to make decisions. Well, we distinguish primarily between two categories of users or decision makers: external users and internal users. External users generally include investors and banks and other creditors, those who typically fund the company. Investors have to make decisions on whether or not to invest in or divest out of a company. Bankers and creditors have to decide whether or not to loan a company money or to continue with their present credit facilities. Other external users might include financial analysts, governments or the tax department, employees, and unions. And you can maybe think of others. Internal users are often those that are involved in functional roles within the business. Here's where the decision makers have to ask questions like, how much can we charge for this? How profitable are our product lines? Can we afford pay raises? Or do we have sufficient cash flow to pay dividends? Again, all about making decisions from an internal perspective. And as you can appreciate, the information that internal users rely on is different from the information that external users rely on. And that's why the course and the textbook are broken up into two different components. The first part deals with financial accounting information for external decision makers and users. The second half deals with managerial accounting and the decisions that need to be made by internal users. So this concludes learning objective number 1 on the forms of business organization and uses of accounting information. For learning objective 2, please proceed to the next video.